In this video today, I'm going to break down what investing in the stock market means, whether you guys should be doing it, and if you decide it's for you, how to go about that. So let's get into it. Hi guys, and welcome back to the channel. If you're new here, I'm Jake, a second year economics student, and I put out weekly videos to help young people and students build healthy financial habits that last, so you guys can save more and grow more. So the very word, the stock market, might be a very daunting thing for some people, and you might be one of those, but don't worry, putting money into the stock market isn't just for the Wall Street elites, and it's something that anyone and everyone can be doing. And in my opinion, it is something that students should be included in. And most of you have probably clicked on this video because you've got some sort of interest in the stock market, or you're looking to put some of that spare Christmas money to work. So firstly, I want to highlight, why do we invest? And this is an important point, but it's often overlooked, and it often makes things easier to understand when you're investing, and it's important to bear in mind what your goals are. Put simply, when we invest, we want to increase the purchasing power of what money we have by growing that money so it can buy more stuff in the future. And we aren't doing that when it's put into a bank account, because interest rates are at rock bottom. They're still below inflation, so the purchasing power of money in our banks is slowly being eroded away by inflation. So that just means that we can buy less and less stuff with that in the future. So to counteract the effects of this inflation, we want to put our money to work, and one of the easiest and most simple ways that anyone can do is by putting it into stocks and shares of companies. So we can maximize the rate of return on our money while minimizing the risk that we're exposing ourselves to. And I'll come back to that point later, but I just want to touch on why students shouldn't be doing it. In my opinion, being a young person in their early 20s or late teens, it's the absolute perfect time to start investing. And I think we should definitely be putting spare cash into index funds or ready-made portfolios. So not necessarily investing in individual companies, because that does increase the risk that you're exposing yourself to. But if you can get a consistent rate of return in index funds or ready-made portfolios, you're well on your way to getting a good rate of return on your money. But that is just how I personally go about investing, and I'll go on to speak about indexes more in a second, but you shouldn't just blindly follow what some guy on the internet posting videos is saying. You need to do the research. And why I think investing at the youngest age possible is best, because you allow more time for compound interest to snowball your investment. Delaying just by 5 years in your 20s can literally be the difference of tens of thousands of pounds when you reach retirement age. So just take a look at this example here, and you can see the differences and consequences of delaying investing. So $200 a month for 30 years invested at a 7% rate of return would mean that you arrive at a total pot of $236,735. So whereas investing the exact same $200 a month but 5 years later, so you're investing for 25 years as opposed to 30, you would arrive at $158,579. So you sacrifice $78,000 despite only investing $12,000 less. And that's simply because you shortened the time you allowed your investments to get growth on top of growth, and that is the compounding effect. However, we also know that this compounding effect has a big impact on student debt. So if you have spare cash, why shouldn't you just be paying off your student debt, as that is a technically guaranteed rate of return? Well, let me explain why you should probably rethink that. So for people like me in the UK, the maximum that's going to get charged to your student debt at the moment is 5.6%. So when you're studying, it's at that rate, and then it varies according to your income, which I'll show on a table just up here. And then in the US, the interest rate on your student debt is 4.5%, so roughly the same. But the point is, this interest rate is probably going to be lower than the rate of return you're going to be getting from investing into indexes. So for the period 1950 to 2009, accounting for inflation, the average rate of return on the S&P 500 was 7%. So that's higher than the 5% you're getting charged on your student loan. So you're effectively losing out on 2%, and that doesn't sound like a lot, but compounded over 30 years, that is a huge amount of money. So yes, if you are paying your student loan back early, you are guaranteeing that you're saving yourself 5%. And obviously when you're investing in the stock market, there's no guarantee, and past results are not indicative of future results. And you could even lose money. For example, my ISA was 35% down at one point this year due to the pandemic, but that has since bounced back, and now it's 9%, so that's higher than the 7%. So if you just want to be 100% safe, then yeah, go ahead and pay off your student debt. But for me, in the UK at least, where that debt gets wiped after 30 years, it doesn't quite work the same as other forms of debt. If I was in the US, I would probably consider paying off my student debt first before investing. And before I get into where you should be putting your money in and what sorts of accounts to look out for, if you're finding some sort of value out of this video, then please kindly press that like button, as it helps out the channel. So an index fund is simply a tracker of various companies. So for example, the FTSE 100 tracks the most valuable 100 UK listed companies by market value. So that just tracks that indice over time, and the S&P 500 tracks the 500 most valuable US companies. So by putting your money into these indices, you're diversifying your portfolio rather than investing into 4 to 5 companies, because we don't know what's going to happen. One day a company looks great and then the next there's some sort of scandal. So by diversifying, you're reducing the amount of risk. So when we're investing, we want to minimize 2 things as much as possible in order to maximize our gains. And the first one being tax. So always make sure you're putting your money into tax efficient accounts. Here in the UK, that's called an ISA, or an individual savings account, and you have a total limit of £20,000 a year to put into all your different ISAs. So any gains or income from future investments in these accounts is completely shielded from tax. And the US has a similar thing called the Roth IRA. So just always make sure you're investing through these accounts and protects your gains or income from the taxman. The next thing you want to minimize when investing is fees. So there are lots of active portfolios which have account managers and etc. and stuff like that, but the fees are much higher on these accounts, and just a tenth of a percent can mean the difference to thousands and thousands of pounds compounded over years. So index funds do carry a fee, but they're also much smaller, and then you have to look at all the different competitors to see who's offering the best rate on indexes. So I personally go for Vanguard, as they seem to be the most competitive in the market in the UK at least, and they have the most minimal fees when investing. So I'd recommend taking a look at the different product types Vanguard has to offer and see which ones align with your investment goals, and they do have lots of different options available. And like I said before, don't just chuck your money into anything. I personally go for the Life Strategy 100, but that might not align with your investment goals. And understand what companies you're investing into, what the underlying assets are to those indexes. So I firmly believe that everyone should be investing or putting their money to work rather than it just being eroded away in a bank. And there's no better time to start now. So if you enjoyed that video, please press the like button and subscribe to the channel to keep up to date with all of Student Money Hacks videos, and I'll see you in the next video.